My wife and I have been listening to your show for a while. It seems that you look at investing differently than our advisor. He reminds us that over the long run, the markets go up. So stay the course. You keep talking about being proactive. What moves are you making with your clients right now? Now, David, we could do a whole show on this. So I'm going to ask you, just give us a few examples.
So one of the greatest investors of all time is a gentleman by the name of Ray Dalio. I've mentioned him before.
We quote him often on this show.
Yep. And so his hedge fund, Bridgestone, was one of the most successful ever. He's now basically retired, but runs a family office for his own money. I got to meet him along with Tony Robbins at a conference not that long ago. But Ray's a legend. But one of the things Ray talks about in his he's got a great book out there, by the way. I think he's giving it away free online, so you can just Google this. But he talks about if you have about 8 different investments that are not correlated to each other, that is how you reduce risk. In other words, you can reduce your risk by, according to Ray, I'm quoting Ray, up to 83%. And so we don't just want to buy stocks or bonds. And most advisors, hey, we're going to allocate. You got stocks and bonds, right? Offense and defense, if you will. And maybe they'll do a little commodities or something in there, and we sometimes refer to that as special teams. We always joke about football. The analogy is your equities, your stocks, or your offense trying to score you points. The bonds in your portfolio were typically the defense in your portfolio, a little more safe. And then sometimes you need the little guy on the end of the bench, this funny little guy who's got a heck of a leg, and you only need him every once in a while, but he's really important if you need a great punt or a great kick to win the game, or et cetera. And that sometimes is the alternative investments like commodities, et cetera. And so the problem is if you only have that allocation, stocks and bonds and cash, you only have really 2 or 3 asset classes. So what we do, and our proactive approach, is we're going to show you how to invest in 5 to 7, at least, typically different sleeves or models that are going to cover these different asset classes. And depending on the asset level of the client, this could include a little bit more sophisticated stuff, or it could keep it pretty simple. So the average retiree, we have a portfolio, we call it Smart CAR, kind of right, CAR, and that stands for commodities, alternatives, and real estate. So in other words, we're going to give clients exposure to these areas. And of course, what if commodities, at least the hard ones, so that portfolio, by being proactive, soft commodities have gotten crushed. Chip, I mean crushed during this tariff war, right? That's cocoa, soy, sugar. Those things have gotten hurt. But hard commodities, precious metals, gold, silver, et cetera, platinum, uranium, have skyrocketed at points here. And so proactive means inside the model, we lean to where we think is the most likely to get a better return on a risk-adjusted basis. And then we take that same methodology across a stock portfolio, across a sector-built portfolio, across a absolute return portfolio, across a bond portfolio, et cetera. And then we also want clients to have some dollars that are safe inside on the sideline. Because the other thing is, the reality is, when the market drops down 20%, if you were to buy stocks and just not look for 10 years, you can't lose money. Can't do it. But if you were to only look 6 months out, certainly it could go lower. Even the market lower, we can go down 50%, right? So understanding where you're going to pull income from and building a portfolio that's not just a set it and forget it. And I crack up and these guys, oh, set it and forget it. Yes, the idea is to stay invested in the long term. And Charlie Munger has a great quote. The only thing you don't want to do to compounding interest is interrupt it, right? You want to keep your dollars growing. But you also, at some point, will need income, so you have to pull a sleeve aside that is going to provide income, and that should have very little or no risk to it for the next year or 3 years. And then we have a moderate risk portfolio, and then we have aggressive stuff that is 7 or 10 years out. And again, if your advisor is not doing these things, you may be a great candidate to do what we call a report card, where we'll just show you. We'll give an evaluation. It's not a recommendation. It's just an evaluation. Here's where you are. Here's the things that we see. And if you want to talk to us about what it looks like to go any further than that, that's fine. If not, that's okay too.